Welcome to the Tech Index AI podcast. This is where we blend Tech IP data, reports, charts, all that good stuff, with the latest news in logistics and, well, especially air cargo.
Exactly. We're your shortcut to staying informed. And today, we're really diving deep.
We're looking at the latest Tech Index Air Freight Market update. That's from June 2nd.
Yep, plus some recent stock market news from the 3rd, and a pretty interesting Reuters report on airline challenges from June 2nd as well.
So the mission today, unpack all of this, connect the dots between what's happening with air cargo rates and, the bigger economic shifts.
Find those nuggets of insight you really need. Let's get into it. Where should we start? The rates.
Yeah, let's start with the core TAC index data. The headline number first, the Global Baltic Air Freight Index, the BAI 0.
Okay.
It actually edged up slightly last week, just 0.4% in the week ending June 2nd. Seems pretty minor.
It does on the surface, but here's where it gets really interesting. You look back 12 months, and that same index, the BAI 0, is actually down, significantly down 5.4% compared to this time last year.
Wow, okay. Down over 5%. And I remember back then, wasn't e-commerce really driving things?
Absolutely. That was a period of really strong e-commerce activity pushing rates up. So this drop tells you something, right?
Yeah, it suggests the market's definitely softer now, even with that tiny weekly bump.
Yeah.
The underlying pressure isn't the same.
Exactly. The pricing power isn't what it was when e-commerce was, booming. Now, the TAC index data breaks this down regionally, which is where you see the real variations.
Okay, let's look at that. China first. Major export region. Rates were up slightly again.
Yeah, slightly up again from China to both the U.S. and Europe last week. And interestingly, the source note's general cargo seems to be keeping rates steady.
Even though e-commerce activity is down? That's interesting.
It is. It sort of suggests a shift, maybe. Less direct consumer stuff, more traditional business shipments, perhaps.
Could be. And the U.S. trade situation. That's still messy, right? Tariffs.
Oh, yeah. The source mentions that uncertainty is still hanging over that lane. Trade with the U.S. is, quote, in flux.
Right. Okay, specific indexes then. Outbound Hong Kong, BAI 30, gained 0.8% week on week.
Yep, 0.8%. But again, like the global index, it's still down year on year, minus 6.3%.
And spot rates helped that weekly rise, but it was already slowing down by the end of the week.
Correct. And Shanghai, BAI 80, that saw a stronger weekly rise, up 3.7%.
Okay, better. But still negative year on year.
Still negative, down 5.3% compared to last year. We also saw rates rising again out of Vietnam to Europe and the U.S.
And India.
India was mixed, up to Europe, but slightly lower overall to the U.S. It just shows, doesn't it? These regional differences are huge. The global average masks a lot.
Totally. Okay, flipping over to Europe, rates up again to the U.S. and Japan.
Correct, but lower going to China. And even within Europe, you see contrasts. Look at Frankfurt, BAI 20.
What happened there?
It dipped pretty significantly, actually, down 6.5% week over week.
Ouch. So that pulls it negative year on year, too.
Yeah, it's sitting at minus 4.7% year on year now.
But then London Heathrow, the BAI 40, that was completely different.
Completely different. It surged, up 5.7% week over week.
Wow. Enough to push it positive year on year.
Yes. It's now actually plus 5.2% compared to last year. That's a stark contrast to Frankfurt, isn't it?
It really is. That London jump is, a bit of a head-scratcher against the general trend, maybe something specific to that market. Urgent shipments.
Could be. Hard to say from just the index, but it definitely stands out. Then you look at North America, also a mixed bag. Rates falling sharply to Europe and China.
Sharply is right. Outbound Chicago, the BAI 50. What was the drop there?
A big one, down 9.6%, just in 1 week.
Whoa, that's a serious drop. Pulled it back into negative territory year on year.
Yep, now down 7.2% year on year. But interestingly, rates from North America to South America were actually increasing again.
Okay, so lots of volatility. That Chicago drop, the London surge, it really shows how specific lane conditions can swing things wildly, even when the global average barely moves.
Exactly. It's definitely not one single market. Which is why it's good TAC index is adding more lanes, right? Europe to India, UAE, Mexico, Brazil,
Australia, South Africa, Mexico to Europe, China to India, Spain, Australia.
Yeah, all those new routes, more data points just give you a clearer, more granular picture of these, shifting dynamics.
Agreed. Okay, so that's the rate picture from Tech Index. Now let's try and connect this to the bigger picture, the macro market, the wider logistics landscape, based on the other sources.
Right, because these rates don't happen in a vacuum. They reflect what's going on economically. And a big theme coming through is trade barriers. Policy uncertainty.
Yeah, that Reuters article quotes the IATA Director General, Willie Walsh. He was pretty direct.
What did he say?
Basically, that trade barriers are risky, they could damage the global economy. Said it's the opposite of what connectivity, like flying, does, which builds wealth. He called isolationism and fragmentation destructive. Strong words.
Very strong. And you can see how that directly impacts air cargo, right? If trade slows, goods movement slows. And it seems like that uncertainty is trickling down to consumers, too.
Yeah, the stock market report mentioned that. The JetBlue CEO, Joanna Garrity, apparently said the consumer is uncertain. Which ties back to the tariff thing, doesn't it? If tariffs push prices up.
People feel it. And look at the stock market reaction mentioned in that report. Discount chains seem more appealing. Dollar General shares jumped 16% after they raised their outlook.
16%. That feels like a signal, right? Consumers maybe tighten belts, looking for value.
It certainly suggests caution. And it's not just feelings. The economic forecasts reflect it. The OECD cut the U.S. growth outlook.
And they predict the whole world economy will slow this year.
Yeah, and they specifically pointed to uncertainty from U.S. trade policy as a hampering factor.
Which then probably explains why IATA trimmed its own airline profit forecast for 2025 slightly.
Exactly. It went from $36.6 billion down to $36.0 billion. Still up from 2024, mind you. But that little trim reflects those macroeconomic headwinds Walsh was talking about.
And on top of that, you had weak manufacturing data. That was in the stock market news, too.
Right. Chinese factory activity apparently tumbled in May, and that followed weak U.S. manufacturing data, and U.S. factory orders were down more than expected in April, like 3.7%.
In manufacturing output.
Right.
Well, that's directly linked to stuff needing to be shipped by air, by sea, whatever.
Precisely. So weaker factory activity in China and the U.S. That points towards softer demand for logistics, including air cargo. It all kind of fits together. Trade worries, consumer cautions, slower growth forecasts, weak manufacturing. It paints a picture of, well, pressure on demand.
Okay, so that's the demand side being squeezed by the economy and trade policy. But what about the supply side? The airlines themselves, the sources mentioned some big challenges there too, right? Affecting capacity.
Oh, definitely. And a massive one is these aircraft delivery delays. The Reuters report made it sound like airline bosses are extremely unhappy, calling the delays unacceptable.
Dampening growth, they said. And Willie Walsh, again, he really didn't hold back.
What else did he say?
He called predictions of these delays lasting through the decade off the chart unacceptable. Said the manufacturing sector, meaning, Boeing and Airbus, is failing badly.
Wow. Failing badly. That's quite the statement from the head of IATA. Did he give any numbers?
Yeah, apparently planned aircraft deliveries for 2025 are expected to be 26% fewer than what was promised just a year ago.
26%? A quarter less capacity coming online than airlines were banking on? That's huge.
It really is. Fewer new planes means less potential belly space for cargo, as well as fewer passenger seats. The report said airlines are looking at legal options.
But they'd rather work with the manufacturers.
Seems so, though some customers were getting agitated, was the word used for the CEO of Flyadeal. Lack of transparency from the plane makers.
Well, you can understand the frustration. This is a fundamental supply constraint. Never mind demand. If the planes aren't showing up, the system's capacity is limited, period.
And there's another challenge mentioned. Sustainable aviation fuel, SAF. Getting enough of it.
Right. Supplies are scarce. Walsh even mentioned energy firms in Europe adding extra charges over mandatory quotas. Another cost headache.
And even though production is set to double in 2025, it's still going to be tiny, right? Like 0.7% of total fuel consumption.
Yeah, a tiny fraction. So scaling that up is clearly a huge long-term challenge for the industry, making progress, but slowly.
Okay, so let's try and synthesize all this. We've got the TAC index rates, the macro picture, the airline's own operational headaches. What are the key takeaways? What should you, listening, really focus on?
Right, let's boil it down. First, the global air cargo rates, BAI 6SI, edged up slightly week on week, but don't let that fool you. They're still way down compared to last year's e-commerce highs.
But keep an eye on those regional variations. Some lanes, like Shanghai and especially London Heathrow, showed surprising strength. Big divergences.
Second takeaway, the macro environment is tough. Trade tensions, policy uncertainty, weak manufacturing data. It's all putting a damper on demand for air cargo. And consumer uncertainty is part of that mix, too.
And third, don't forget the supply side. Those huge aircraft delivery delays Walsh talked about, they're real, they're significant, and they're constraining capacity no matter what demand does. That's not going away quickly.
So you've got this dynamic, right? Softer demand hitting up against these quite serious supply constraints from the manufacturing side. It's complex. No single factor explains everything.
And those regional REIT differences really reflect that complexity.
Absolutely. So we've taken quite a deep dive today using the TAC index data and these reports as our guide.
We've seen how those rate movements, even small ones, connect to these really big themes: global trade, economic health, and the airline's own operational realities, like just getting the planes they ordered.
Yeah, the picture isn't simple at all. Some rates up, others down sharply. All happening against this backdrop of economic headwinds and those stubborn supply chain issues within aviation itself.
It definitely gives you a lot to think about when you're looking at logistics and market signals.
For sure.
So here's something to mull over as you digest all this. How might those ongoing, inexcusable aircraft delivery delays continue to squeeze air cargo capacity? Could that fundamental supply problem actually start to override softer demand from the economy?
Meaning rates could potentially feel upward pressure or supply chain reliability could suffer even if trade tensions simmer down.
Exactly. Could that supply constraint become the dominant factor impacting rates and reliability down the line? Something to keep in mind.
That structural challenge on the supply side definitely feels like a key variable to watch in the coming months and maybe even years.